Hello everyone, it is time to get smart about your money. Today, we are talking about something very important if you want to step into the world of trading, especially with cryptocurrencies like Bitcoin or even stocks. You have probably heard the words spot trading and futures trading. They might sound complicated, but I promise you they are not. My goal today is to make these ideas so simple that anyone can understand them. Knowing the difference is not just for the professionals on Wall Street, it is for you. It is for anyone who wants to take control of their financial future and make informed decisions. This knowledge is your power. Why is this so important right now, on September 26, 2025? Because the financial world is changing faster than ever. Digital currencies are no longer a niche hobby. They are a major part of the global economy. People are making and losing money every single day. If you are going to participate, you must understand the rules of the game. You would not play a card game without knowing the rules, would you? Of course not. So why would you put your hard-earned money into something you do not fully grasp? Understanding spot versus futures is the first, most critical step to becoming a smarter, more confident trader. Throughout this guide, I'm going to hold your hand and walk you through everything. We will break down what each type of trading means using examples you can actually relate to. Think of it like buying a car. You can buy the car today and drive it home, that is like spot trading. Or you can agree to buy a car in 3 months at a price you decide on today. That is like futures trading. See? Not so scary. We will look at the good parts and the bad parts of each, so you can see the full picture clearly and honestly. My promise to you is this. By the end of this discussion, you will feel more empowered. You will have the clarity you need to decide which path, if any, is right for your personal financial goals and your tolerance for risk. We will even talk about how new technology like artificial intelligence is helping traders make smarter moves in both arenas. This is not about getting rich quick. It is about getting smart, staying safe, and building a secure financial foundation for yourself and your family. So let's get started. Let's get approved. Let's start with the simplest one, spot trading. The name says it all. You are buying or selling an asset on the spot. This means the transaction happens right now or very close to it. You pay the current market price and you get the asset immediately. It is the most direct and common way people trade. Think about going to the grocery store. You see a beautiful apple, you check its price, you pay the cashier, and you walk out with the apple. You own it. You can eat it, save it for later, or sell it to a friend. That is spot trading in a nutshell. In the world of finance, it works the exact same way. If you want to buy one share of Apple stock, AAPL, you go to your brokerage account. You see the current price is, let's say, $200 per share. You click buy, and the money leaves your account. In return, the one share of AAPL stock is now in your account. You are now a part owner of Apple. The same applies to cryptocurrency. If you want to buy Bitcoin, you go to a crypto exchange. You see the price is $100,000, you buy it, and the Bitcoin is transferred to your digital wallet. You own it outright. The key words here are ownership and immediacy. When you spot trade, you are taking direct ownership of the asset. It is yours to hold, to keep for the long term, or to sell whenever you want. There is no contract with a future date. There are no complicated terms. The price you pay is the price everyone sees in the market at that very moment, called the spot price. This straightforward nature is why most people who are just starting their investment journey begin with spot trading. It is intuitive and reflects how we buy and sell things in our everyday lives, making it a comfortable first step. So, to be crystal clear, spot trading is the act of buying or selling a financial asset for immediate delivery and payment at the current market price. There is no loan, no leverage, and no expiration date to worry about. You are simply exchanging one thing for another, your money for an asset. This simplicity is its greatest strength, but as we will see, it also comes with its own set of limitations. For now, just remember the apple at the grocery store. You see it, you want it, you buy it, it is yours. That is spot trading. The biggest advantage of spot trading is its beautiful simplicity. I cannot say this enough. There are no complex contracts to read, no expiration dates to track, and no leverage to worry about. What you see is what you get. The price is clear, and the ownership is direct. This makes it the perfect entry point for beginners. You do not need a degree in finance to understand that you are buying a piece of a company or a digital coin. This low barrier to entry empowers more people to start investing and take an active role in their financial growth, which is something I am very passionate about. Another huge plus, is that you have full ownership and control over your asset. When you buy that share of stock or that Bitcoin, it is 100% yours. You can hold it for 10 years as a long-term investment, a strategy often called hodling in the crypto world. You can sell it tomorrow if the price goes up. If it is a stock that pays dividends, those dividends are paid directly to you. This direct ownership gives you a tangible connection to your investment. You are not just betting on a price, you are owning a part of something, which can be a much more comfortable and secure feeling for many people. Now let's talk about how technology helps. Artificial intelligence, or AI, has become a powerful tool even for simple spot traders. AI-powered platforms can analyze massive amounts of market data in seconds. They can identify trends, spot potential buying opportunities, and even send you alerts when a specific crypto or stock hits a price you are interested in. Some AI tools can help you with dollar-cost averaging, automatically buying small amounts of an asset over time to smooth out price volatility. This takes the emotion out of buying and helps you stick to a disciplined strategy, which is the key to long-term success. Finally, the risk in spot trading is very straightforward to understand. The most you can lose is the money you invested. If you buy $1,000 worth of a cryptocurrency and its value goes to zero, you have lost your $1,000. That is painful, of course, but your loss is capped. You will never owe more than what you put in. This is a critical safety net for beginners. Unlike other forms of trading, you cannot get a call from your broker saying you owe them more money. This limited risk makes spot trading a more responsible choice for those who are still learning the ropes and cannot afford catastrophic losses. While spot trading is simple, that simplicity comes with limitations. The most significant disadvantage is that you can only make money when the market goes up. This is called going long. You buy an asset hoping its price will increase so you can sell it for a profit. But what if you believe the market is going to go down? With spot trading, your only option is to sell what you own or simply sit on the sidelines and wait. You cannot actively profit from a falling market, also known as a bear market. This means you are missing out on potential opportunities during market downturns. Another drawback is the lack of leverage. In spot trading, your buying power is limited to the cash you have in your account. If you have $100, you can only buy $100 worth of Bitcoin. While this is safer, it also means your potential profits are smaller in scale compared to leveraged trading. If Bitcoin's price increases by 10%, your $100 investment becomes $110, giving you a $10 profit. For traders looking to make more significant gains from smaller price movements, this can feel restrictive. You need a lot of capital to make substantial profits, which many new traders simply do not have. Furthermore, spot trading requires your capital to be tied up in the assets you purchase. When you buy a stock or a cryptocurrency, your money is locked into that position until you decide to sell. This can be an issue for active traders who want to move in and out of different positions quickly. If a great opportunity appears in another asset, but all your money is invested in something else, you might have to sell your current holding, perhaps at a bad time, just to free up cash. This lack of capital efficiency can limit a trader's flexibility and ability to react to fast-moving markets. Lastly, while owning the asset is a good thing, it also comes with responsibilities, especially in crypto. You are responsible for the security of your digital assets. If you store your Bitcoin in a personal wallet, you must protect your private keys. If you lose them, your Bitcoin is gone forever. If you leave your coins on an exchange and that exchange gets hacked, you could lose everything. This custodial risk is something you do not have to worry about as much with other forms of trading where you do not take direct ownership of the underlying asset. Security is a real and constant concern for spot crypto traders. Now let's shift gears and talk about futures. A futures contract is a completely different animal. Please listen closely. A futures contract is an agreement, a legal contract, to buy or sell an asset at a predetermined price on a specific date in the future. You are not buying the asset today, you are locking in a price today for a transaction that will happen later. Think of it like booking a hotel room for a vacation next summer. You agree on the price per night today even though you will not be staying there for months. You are speculating on what the value will be in the future. Let's use a simple example outside of finance. Imagine you are a baker, and you need a lot of wheat in 3 months. You are worried the price of wheat will go up. So you make a deal with a farmer today. You agree to buy 1,000 bushels of wheat from him in 3 months for $10 per bushel, no matter what the market price is on that day. You have just entered a futures contract. The farmer is happy because he has locked in a sale price, and you are happy because you have protected yourself from rising costs. You are both managing your risk by agreeing on a future price today. In the financial markets, it works the same way. But most traders are not interested in actually getting the wheat, or the Bitcoin, or the barrels of oil. They are speculators. They are betting on the price movement. If you think the price of Bitcoin, currently at $100,000, will be higher in 1 month, you can buy a futures contract. This contract gives you the right to buy Bitcoin at, say, $101,000 on the expiration date. If the actual price of Bitcoin shoots up to $110,000 by then, your contract is very valuable. You can sell the contract for a profit without ever touching the actual Bitcoin. The key difference here is that you are trading a contract, not the asset itself. You are making a bet on the future price direction. This allows you to do something you cannot do in spot trading profit from a falling market. If you believe Bitcoin's price will drop, you can short a futures contract. This means you agree to sell Bitcoin at a future date for a set price. If the price does indeed fall, you can buy it at the new, lower price to fulfill your contract and keep the difference as profit. This flexibility to go both long, betting it goes up, and short, betting it goes down, is the main attraction of futures trading. The single most powerful feature of futures trading is leverage. Aha! This is a word you must understand. Leverage is like a financial superpower. It allows you to control a large position with a small amount of money. For example, with 10 times leverage, you can use just $1,000 of your own money to open a trade worth $10,000. This magnifies your potential profits. If that $10,000 position increases in value by 5%, your profit is $500. On your initial $1,000, that is a 50% return. This ability to amplify gains is what draws many ambitious traders to the futures market. Beyond speculation, futures are an essential tool for hedging. Hedging is just a fancy word for protecting yourself. Imagine you are a Bitcoin miner. You own a lot of actual Bitcoin, and you are worried the price might drop in the next few months. To protect your investment, you can sell Bitcoin futures contracts. If the price of Bitcoin does fall, the losses on the Bitcoin you hold will be offset by the profits you make on your futures contracts. This is how large companies and professional investors manage risk. They use futures as an insurance policy against unfavorable price movements, creating stability in a volatile market. Futures markets also offer incredible flexibility. As we discussed, you can profit whether the market goes up or down. If your analysis tells you a stock or crypto is overvalued and due for a correction, you can open a short position and profit from the decline. This opens up a whole new world of trading strategies that are simply not available to spot traders. It allows savvy traders to find opportunities in any market condition, whether it is a raging bull market or a fearful bear market. This versatility is a major advantage for those who actively manage their portfolios and want to capitalize on every potential market move. And yes, artificial intelligence is a game changer here too. The complexity of futures trading with its leverage and expiration dates makes it a perfect place for AI to shine. AI algorithms can analyze price charts, trading volume, and even news sentiment to predict future price movements with incredible speed. They can execute trades automatically based on a set of predefined rules, helping traders manage the risks of leverage. Advanced AI can even identify complex hedging opportunities that a human trader might miss. For professional traders, using AI in futures is no longer a luxury, it is becoming a necessity to stay competitive. I told you leverage was a superpower, but every superpower has a dark side. The same leverage that magnifies your profits can also magnify your losses. This is the #1 risk of futures trading, and you must respect it. With that same 10 times leverage, if your $10,000 position goes down by just 5%, you have lost $500. That is half of your initial $1,000 investment gone in a flash. If the position moves against you by 10%, your entire $1,000 is wiped out. This is called liquidation. The broker automatically closes your position, and you lose your entire initial margin. You can lose money much faster than in spot trading. Another critical risk is the deadline. Remember, a futures contract has an expiration date. This creates time pressure. In spot trading, if you buy a stock and the price goes down, you can afford to hold it and wait for it to recover even if it takes years. You have time on your side. With a futures contract, you do not have that luxury. If your prediction about the price is wrong and the expiration date is approaching, you might be forced to close your position at a loss. The market did not move in your favor within your specific time frame. This pressure can lead to poor emotional decisions. The complexity of futures contracts is another hurdle. You are not just worried about the price, you have to understand things like initial margin, maintenance margin, funding rates, and settlement procedures. These concepts can be overwhelming for a beginner. If you do not fully grasp how they work, you can make very costly mistakes. For example, if your trade goes slightly against you, you might get a margin call, which is a demand from your broker to add more money to your account to keep the position open. If you cannot, your position is liquidated, often at the worst possible moment. Finally, futures trading can be emotionally draining. The combination of high leverage, fast-moving prices, and the constant threat of liquidation creates a high-stress environment. It can encourage over-trading and gambling-like behavior. People get hooked on the adrenaline rush of big, fast profits and start taking bigger and bigger risks, often leading to a complete wipeout of their account. This is why I say futures trading is not for everyone. It requires a level of emotional discipline, risk management, and knowledge that most beginners simply do not possess. It is a professional's game with very real dangers. Let's put these two trading methods side by side so the differences are crystal clear. The most fundamental difference is ownership. With spot trading, you buy and own the actual asset. It is yours. You can withdraw your Bitcoin to a private wallet or receive dividends from your stock. In futures trading, you do not own the underlying asset. You own a contract that speculates on its price. You are essentially trading a piece of paper or a digital equivalent that represents a promise, not the asset itself. This is the core distinction from which all other differences flow. Next, let's compare market direction. Spot trading is a one-way street. You buy low and sell high. You only profit when the price goes up. This makes your strategy dependent on bull markets or finding undervalued assets that are poised for growth. Futures trading, on the other hand, is a two-way highway. You can go long, betting the price will rise, or go short, betting the price will fall. This gives you the flexibility to develop strategies for any market condition, making it far more versatile for active traders who want to capitalize on both upward and downward trends. Then there is the issue of capital and leverage. In spot trading, your investment power is 1-to-1. To buy $5,000 worth of Ethereum, you need $5,000 in cash. Futures trading introduces leverage, allowing you to control that same $5,000 position with a fraction of the capital, perhaps only $500. This makes futures more capital efficient as it frees up your money for other trades. However, this efficiency comes at the high price of amplified risk. Spot trading is less efficient but inherently safer because your losses are limited to your initial investment and are not magnified by leverage. Finally, consider the time horizon. Spot trading is ideal for long-term investing. Since you own the asset, you can hold it indefinitely, riding out market volatility over months or even years. There is no deadline forcing you to sell. Futures contracts, by their very nature, are short-term to medium-term instruments. They have fixed expiration dates, which forces a time limit on your trade. This makes them suitable for short-term speculation on price movements, but inappropriate for a buy-and-hold long-term investment strategy. The time frame of your financial goals should heavily influence which method you choose. So, which one is right for you? There is no single answer that fits everyone. It all comes down to your personality, your financial situation, and your goals. If you are a beginner, if you have a lower tolerance for risk, or if you are looking to invest for the long term, then spot trading is undeniably the better and safer choice. It is simple to understand, your risk is limited to what you invest, and it allows you to build a portfolio of assets you truly own. The strategy here is often buy and hold or dollar-cost averaging, focusing on quality assets you believe in for the long haul. On the other hand, if you are an experienced trader, if you have a deep understanding of the markets, and if you have a high tolerance for risk, futures trading might be for you. It is designed for active, short-term traders who want to capitalize on price volatility in either direction. It is also a powerful tool for sophisticated investors and businesses who need to hedge their existing holdings against potential losses. The strategies here are more complex, involving technical analysis, short selling, and careful management of leverage. This is not a place for the faint of heart or the unprepared. Let's be very direct. If you are new to this, start with spot. I cannot stress this enough. Walk before you run. Learn how the markets work, get comfortable with volatility, and build a solid foundation of knowledge. Use a small amount of money that you can afford to lose. Think of it as your financial education tuition. Only after you have proven you can be consistently profitable in the spot market should you even consider looking at futures. Jumping into leveraged futures trading without experience is one of the fastest ways to lose all of your trading capital. Ultimately, the choice is a reflection of your personal financial philosophy. Are you an investor or a trader? An investor builds wealth slowly and steadily by owning valuable assets over time. That is the spot market. A trader seeks to generate quicker profits by speculating on short-term price movements. That is the futures market. Both paths can lead to success, but they require different skill sets, mindsets, and risk management plans. Be honest with yourself about who you are and what you are trying to achieve before you put a single dollar at risk. Your financial well-being depends on it.